Welcome to the Tearsheet Podcast. I'm your host, Zach Miller. There's change afoot in commercial banking infrastructure. Virtual account management, once the domain of only the most cutting-edge Tier 1 banks, is rapidly becoming critical for any institution that wants to compete for sophisticated commercial clients, and the pressure is coming from multiple directions. Corporate treasurers are demanding real-time visibility across entities and currencies. Fintechs and embedded finance platforms are raising the bar in expectations. And opening dozens of physical accounts to segment funds is operationally untenable for both banks and their clients. To make sure they remain competitive, banks just need to learn how to modernize without the operational nightmare of parallel ledgers and system mismatches. Today, I'm joined by two people at the center of this shift. Deepak Kapoor is head of payment products at Huntington National Bank, and Roozbeh Rotabi, the COO of Qolo, the infrastructure provider helping banks like Huntington modernize above the core without replacing it. We're going to talk about what's actually driving banks to act now, how virtual accounts change the game for commercial clients, and why this foundation is critical for everything from embedded treasury to real-time liquidity networks. Let's dive in. Great. So Roozbeh, we'll start with you. Qolo is entrenched in this VAM movement. So give us the lay of the land. How has the conversation around virtual accounts changed?
Yeah, I think the conversation has changed because of three components. One, the people that are the corporate treasurers or the CFOs have become their younger generation. Mm-hmm. And what they're looking for is more digital native solutions or something that's a little bit more modern. So that puts extra weight inside of the banking infrastructure because you have to meet the customer where they're at, which is an age-old saying. The second thing I think is changing is that business entities are becoming much more complex. Before it was, I open a business, I have one entity, and I run everything through that main account. But now because you have payroll, you have money in, you have money out. If you're an e-commerce business, you're moving money overseas, you're moving money across borders, you have FX, and then you have many, many different entities inside of that organization now. And I think the third thing is that the banking infrastructure it's time for things to change, things to adapt. And we'll get into this a little bit more later, but I think banks look at their core different than what they look at their value-added services or different components that go around the core, and it's all coming together. So if you look at them all in a timeline aspect, the consumer's demands are becoming higher so that you have that apex going up. And then you have the banking infrastructure kind of staying flat. So now you're looking for other solutions that can fit the gaps and fill in the middle or the outside to improve the banking experience. The thing that no one predicted was the run of banks that we had a few years ago. I don't think that was that was very unfortunate. And I think that's the added dynamic that's making banks wonder, how do I gain more market share? How do I deliver more services? And how do I make sure that I keep moving ahead so that I can compete amongst my subset of banks, whether you're top 20, top 100, whatever it may be, community, regional, it's all fit in there. I'd love to hear from Deepak's perspective, having been on the other side.
Yeah, I think from our perspective as Huntington Bank, I would say three things that have changed over time. One, we've all understood that the core in a bank is very complex. It's hard to replace, and it always be limited capabilities versus what the modern payments needs are. Both specialized, e.g. an escrow client or any other complex client. I think that's one thing. So a virtual account structure on top of a core makes immense powerful, gives immense powerful capability to a bank. I think that's one. I think the second is a lot of our customers, and it's probably true for a lot of banks, are multi-bank customers. And the complexity at a customer end quadruples when you have four banks involved, and a structure like a VAM comes very handy. And then obviously it's similar to when you have an iPhone, you realize BlackBerry is not good enough, right? So similar to that, now you have capabilities that can combine money in, money out capabilities with the virtual account, with the ledger and issuing and all combined. So it's a bit of that iPhone moment and saying, oh, I can get more, right? And I think those are the three things that's going on, at least on the bank side.
So that sounds like a powerful realization. Ruzbeh, like, what are you seeing across your client base and the banks that you're speaking to? Is there a critical mass forming around this realization?
I think there is, and this is not to say anything um, negative about what's in place, but legacy systems, whether it's healthcare, banking core structures, educational platforms, there's always a time for things to come over. At the turn of the century, which seems like a century ago itself, I worked at a company called ADP, and we did payroll for folks. And it's the seven, ADP pays 1 out of 7 people on this planet. And there was this big thing around Y2K, if we all remember that, for those that go back in the day. ATMs might stop working, checks might get bounced, et cetera, et cetera. Why was that? That was because no one when they did the programming in the 50s, 60s, and 70s, no one thought to take the year to 4 digits. So everyone's worried it's going to go back to 1900. I think what's happening now is that the legacy players and the legacy providers that provide really big banking core infrastructure, I think everyone's slowly realizing it. We've heard this from multiple treasurers and multiple CFOs and people such as Deepak, that at some point the banking core might just be a debit and credit system to keep track of every dollar and cent the bank has on deposit so that I can report my financial statements. I will then leverage services like companies like Qolo and someone else for identity and someone else for security and build it all around the core. So you basically make the core from the provider a debit and credit system, and then you have all these other services around it so that you can modernize your infrastructure. Because to Deepak's point, changing the core out is a 5 to 7 year process, and you have to account for every nickel and every penny. So if that transition is creating a wave and a movement amongst virtual account management. Anecdotal story, McKinsey did a study and said that basically 54% of the top 120 banks are looking at virtual account management and have not made a decision which way to go.
Deepak, I want to take it over to you and get a little bit into the specifics. And what were some of the core business drivers behind Huntington's move to launch connected deposits?
I think for us, it was very simple. We are a very verticalized bank. We focus on a lot of verticals, healthcare, government, but specialized verticals like title companies and escrow segments. And I think we very quickly realized we don't have all the Lego pieces in place to build the card that we want to build. And the ledger and the virtual account, provides us that, is that missing Lego piece that we needed. So it was pretty obvious from there on. And we have our own legacy virtual account systems. We do, but they're all manual and they don't work the way we want a virtual account to work. Our target for virtual accounts was it needs to be a real ABA routing number. It needs to behave to external world like a real bank account. And then internally, it does all the reconciliation, settlement, and ledgering the way it's supposed to do. And for that, we just needed the Lego piece that we needed. So yeah, and I think for us, building it in-house was a consideration. But again, building something in the core is very hard. So for us, it became how do we marry both the worlds and leverage capabilities that we can partner with versus build ourselves. So it was pretty simple from there forward.
Hey, Zach, I want to bring some context to this. So if you think about it, I'm a treasurer. I'm a reformed accountant. I was a CPA out of college. But if I'm a treasurer of an entity that owns 50 McDonald's, in the old legacy system, in each McDonald's is its own entity and its own EIN. The issue is that the bank would then have to create, if I went to Huntington and moved all my business from XYZ Bank, in the old days, before Qolo and Huntington created the Connected Deposits partnership together, I would have, as a CFO, 50 bank accounts, 50 debit cards, 50 routing number, or 50 different account numbers. So if you think about the amount of load work that creates for my and the finance team, just to make sure that all of those funds are on one simple balance sheet, that's a pain. For the banks, it's the same thing. Why do I need 50 different accounts on the main core system that could go out of balance at any one time, creating more work for myself, creating more work for my commercial banking team, and then obviously the office of the CFO, he or she will have to do all that work to reconcile. So we could just have one master account on the core, and Qolo provides a solution where all the virtual accounts sit on our platform, do all of the reconciliation on a daily basis or in sequence with the bank's timing, and the bank gets one number from us on a daily basis for their total deposits or money moved for XYZ entity that owns 50 McDonald's, then we create the subledger where the CFO or the controller or the treasurer interacts and moves money in between each one of those McDonald's.
That makes a lot of sense. We have a lot of guests on this program that talk about the challenges of core modernization, and what Deepak just described was, a better way forward that doesn't really require getting stuck in ripping out the core. Back to you, Ruzbe. Like, is that the key for banks who feel stuck with legacy systems?
It absolutely is. The one of our thesis is the three premises to Qolo is: one, unify all the different aspects. So ledger, money in, money out, and tracking. Two, card issuing, because card issuing is whether it's virtual cards or physical cards. And three is money movement. Those three should all be on one platform. And if you look at the companies that have come out, and I've worked at a few of them for the previous 12 years, it was almost single point solutions. And it was, I buy ACH from this person, issuing from this person, a ledger from this person. Then my product and engineering team has to connect all of that. And I think that's what bankers are starting to realize. That's what everyone's starting to realize, that if you can bring one modern solution into the fold, you're going to create more surface area that you cover. You're going to have less load weight, but you're going to have to do a lot of customization in some instances and deliver that to the end market. So I think the banking community has been asking for this. People like Deepak, and Deepak's worked at a couple of different banks, and he can give you the examples. But I think the bankers are all saying there has to be an easier way where I don't sit as the 38th priority on the core when there's only a list of 7 that we'll ever get to.
So Deepak, I'd love if you could help to translate this into value for the end user. So if I'm a commercial client at Huntington, what does connected deposits change for me?
I think for the client, Ruzbe touched on a few things. If you take a step back, it's basically enabling your specific need. If you're a title company, as an example, and you're in the business of supporting buying and selling property, the way it would work for you, you open a virtual account in like 5 seconds for a seller and a buyer that's working with you. You keep the money in that virtual account. It's a real bank account number. You get a wire in. The money sits there till the time the deal is done. And the money is released from that same virtual account without having to go to some other account. So think about that. In 5 seconds, you open a bank account for your transaction. It stayed active for whatever duration was required. The money came into that account and went out from that account. There's no reconciliation to be done. It's automatically happening, right? That power is what drives, the value to the customer. Obviously, you can simplify your operational structures. A lot of customers open bank accounts because of legal entities, because of, just money in capabilities. They have accounts that are just money in accounts versus money out accounts. And they're all doing it for reconciliation purposes. So behind that, there's an army of people that is helping reconcile. I think with this, you're also giving them richer data to reconcile. Half of the reconciliation is automatic. Beyond that, to an API or files, you can get better reconciliation data. And I think that's the power to the client is, they now themselves have their own workflows where they can take our APIs and embed the capabilities within their workflow. And that is very powerful for them because they don't want to be working from banking systems. However, we like them because I'm with the bank and we like our systems. But our clients have our own systems. They have their own workflows. And they would like to embed these payment capabilities within their workflow. So that's the third most powerful thing is that they stay within their workflow. So clients are loving it so far. I think we've had really good success so far. There's much more to do for us, but that's where we are.
And Ruzbe, you talked about, in terms of use cases, this not just being about money movement. Can you give us some other positive outcomes that your clients see?
Absolutely. And I think this has been something that we've seen over the last 2.5 years. So if going back and putting ourselves in the minds of a banker who's trying to serve a commercial CFO or treasurer, whoever it may be, it's what's the extension of services I can offer them to what Deepak was just speaking about. And what we're seeing is that banks are saying, okay, I now see the way with cloud native infrastructure. I now see the way with things that can tie into my core and reconcile through a BAI2 file or through an API. And as the world goes further and further into APIs and a little bit of UX and UI, you can build a lot more around it. Before, everything had to be on that core dot matrix DOS experience. And now that's changing. So I think what's happening from our end, we at Qolo typically work with folks like Deepak, the EVP of payments, the head of treasury, the head of deposits, and they're looking for ways to enhance their core. They're looking for ways to really drive value out of each and every single customer from a portfolio yield standpoint. So if you're offering them a line of credit, but you don't do their corporate banking, you do their lending, why not go and pitch connected deposits and say, hey, we can offer you all the treasury services. We can offer you your payment services, and payments are different. You're either moving money in and out via ACH. You might be issuing virtual cards, or you might have people in the field that have actual physical T&E cards. Now I'm giving you a more robust solution through the connected deposits platform. I'm selling that in while I'm also doing your lending. So Deepak brought up escrow. And there's certain verticals that this is perfect for franchisors. So you're getting now more of the share of their mind of what services am I outsourcing to the bank? And it's really being disassociated with a true bank in quotes. It's a payment service through the bank. It's commercial payments, it's commercial deposits. Banks are really good at lending money and they're really good at taking in deposits. But now you add in these other legs to a stool and you have a more broad surface area, as we were talking about before. And I think the CFO is now saying, okay, I don't need 7 vendors. I can get more from my bank. I could probably get economies of scale on cost, and I could simplify my end employee's experience. So I think that's what they're looking for. I wouldn't call it a one-stop solution because financial services rarely is, but I think you might have more banking services piling up in 2 to 3 banks versus spread out over 7.
I'm hoping at this point in the conversation, Deepak, you can help zoom out a little bit. I'm curious about what the long-term vision is at Huntington now that this foundation is in place.
Yeah, no, it's a great question. For us, it's building the tech stack one layer at a time. This is the foundation has to be strong, similar to when you build a house, you have to have strong foundations. I think this is that. Building the very strong, very modular, very scalable, capable foundation. And then now building on top of it is the thing. Examples of what you build on top of it could be risk flows. You're a bank, you want to make sure you're compliant with everything. And how do you connect capability like a virtual account and connected deposits to our risk platforms? How do you build more custom UX on top of it for certain vertical flows? And so that's definitely one for us. I think the second for us is just expanding the use cases. Escrow is one, government reimbursements is another, healthcare. They're just like, we have a list of like 15 plus use cases that we're going after one at a time. And you have to go one at a time because there's lots to be built for that use case. So I think that's those are the 2 broad things for us.
Rusba, I'd like to kick it back to you, like from your vantage point, given where you sit today, but also your experience in the industry, like what does all this say about the future of banking infrastructure?
I think it's changing rapidly. I think because the customer demographic is getting younger and people are becoming more digitally native, I think the banks have all said to themselves in one way, shape, or form, whether we're going to build it, we're going to buy it, or we're going to lease it, we have to start meeting a different need from the customers. The CFO isn't someone that was raised in the pre-UX UI API days. That office is changing. And I think the biggest thing that you're going to see is that you're going to have many companies that come up and help banks build better platforms together. And, Qolo's been in the space for 5 years. There's some other folks that have been around. And I think you're going to see a new guard of folks that are API centric, that are cloud native, that banks are going to rely on. I mean, side note, if you tried to pitch a cloud native product to a bank 12 years ago, they would have laughed you out of the building because it wouldn't have met security parameters. They would have been afraid it's going to get attacked. It's not going to be secure enough, et cetera, et cetera. So I think folks like Deepak are changing the way banks think internally. I think banks are also saying, man, I don't want to go and have to rely on my core technology. I want to start sunsetting as much of that as I can and offloading it to a modern platform that I know is going to be around in one way, shape, or form. And the last piece is that going back to the end customer, the end demographic is drastically changing, and business is getting more complex. We do live in a borderless world for a lot of entities now.
I think if I can add from a banking perspective, having seen it from the inside out also, is the CFO plays a very critical part. Like our own CFO, Zach Wasserman's very supportive, has been very supportive of driving this change. I would also say the payments CIOs are a very critical piece to this thing. More and more banks are realizing, I think, that payments is its own infrastructure. What works for the core or online banking platform is not just payments. And especially if you're in the commercial side of the bank, the mid-market commercial side, payments what drives the deposits, right? People are not opening saving accounts. It's money in, money out that drives the deposits, right? So how do you, create payment expertise in your technology organization? That's what we have done. Kendall, who's our CIO, he's done that. So there's a lot of change that has happened in the mindsets of the industry. Huntington, for example, we're leading that change as part of our whole management team. But it's very critical to bring your CFO along, to bring your CIO along, especially with the payments lens. And I think that's what's massively changing the pace of it. So,
yeah, and I'll add this: the persona. From a sales standpoint, running the GTM team here, from a sales standpoint, the personas that we interact with the most are EVP of payments, CIOs, executive vice president of deposits, treasury, whatever it may be. That cohort of folks are all, like Deepak, to Deepak's point, looking at new services. And it's in conjunction because it's servicing multiple solutions. And I think from Qolo's standpoint, when you go talk to a bank and you can help three different departments, you can help payments, you can help the people that do treasury and money movement, and then you can help deposits, and bring it all together under one roof. That's really the value add, because then they're thinking, okay, less load weight on my product people, less load weight on my engineering teams. Yes, I will be more reliant on Qolo, but I'm getting the service that I need in a coherent manner that does move money, that does track money, that does tie to my lending in some cases, and then do all of the idiosyncrasies of making sure that my core's not out of balance.
I see we're almost out of time, so I want to close with some clear takeaways. Deepak, we'll go back to you. For business owners and finance leaders listening, what's your message to them?
My main message is, if you want payments to grow, you got to build the right tech stack. Some of this you will build in-house, some outside. A flexible approach is very powerful. And the payments landscape is changing very fast. And what used to be our customer 10 years ago is no longer our customer. Our business is coming from very different channels. And I think banks have a very special role to play. And I think banks can be in the forefront versus behind the scenes. And I think that's my message, that banks have an opportunity to lead in payments if they can build the right tech stack and get the right energy behind what needs to be done here. So,
Ruzbe,
how
about you? You have some closing thoughts for banks listening in?
Yeah, I think there's one, which is, Deepak said it, people trust you. So when you have that natural trust, you've already broken down 50% of the barrier to do business with you. Start looking at how you can modernize your infrastructure. Start listening to the ideas that are net new, and don't be afraid of following what the new trend is, because it is a trend. It's not a fad. It's not something that's going to come in and go away. I think modernizing your payments, your deposits, and your ledgering solutions to meet the customer where they're at. Don't think that you could build it in-house faster than you can talk to other folks that might have a better solution, such as Qolo. And I think that time is coming, but leverage your trust and think about how you can modernize everything outside of the core.
Deepak, Ruzbe, thanks for joining us on the Tearsheet podcast today.
Thank you.
You're welcome, Zach. Thank you.